How's it going, everyone? Welcome to the Personal Finance Takeover. My name's Sean. This is my co-host, Fabian. And today we're going to be looking at mutual funds, index funds, and ETFs. We'll look at the differences between them so you could decide which one is best for your investment strategy. Now, something you want to remember to do is hit that like button because it's going to help us out with the YouTube algorithm. And if you don't mind, hitting that subscribe button so you could hear all future videos as well. All right, so let's go ahead and just jump into it.
Let's get started. Yeah, I think today's video is going to be very important because as you start, progressing through your financial journey, once you start paying off your high interest debt, you've built up your emergency fund for like 6 months, kind of want to, start realizing like, what do I do with this extra money? I'm starting to have money left over every month. What can I do? And I think you got to start thinking at this point, whether you invest it, you start buying real estate property, what to do with it, so that way you're able to build your wealth.
Right.
So with these 3 different investment vehicles, I think these are one of the best ways to, introduce yourself into the stock market, because unless you're a day trader or you have the time to sit down and analyze financial reports to pick the best companies or keep up with the news to know because news always affects stock prices. Unless you have the time to do that, then more power to you. But if you want to be one of those passive investors that you want to dump money in there, set it and forget it, I think investing in index funds, ETFs, and mutual funds are the best way to go.
Yeah.
So yeah, let's start it off. What's a mutual fund?
All right. Yeah. So the mutual fund is going to be something that is actively managed. And because of that, it might require some extra fees because they have to pay extra people to do that. But the basic overview of it is it's just everybody pulls their money together and you're investing in selected stocks based on that manager's choice. And these are supposed to be professional people that are picking the best options and they're trying to beat an index. So maybe they're trying to beat the S&P 500 and they're trying to outperform that index. So their whole goal is to do better than the index, which we'll talk about when we get into index funds. But if they could do that, great. But over the long run, typically that's not the case. Yeah. So there's been several things looked at where the index usually in the long run outperforms these actively managed mutual funds. So that's something to consider. But there are a select few that do actually outperform.
I think I was reading an article where it was saying that 90% of actively managed mutual funds don't even beat the index that they're trying to beat over a long period of time. So they might have, a couple wins, a year here or there where they're outperforming the market, but then there's other years where they're not. So that's something to keep in mind because mutual funds do come with heavy fees. You're looking at expense ratios with sometimes up to 2-3%.
Right. Yeah, definitely look at those expense ratios because that's going to eventually make up a good portion of taking away from what your actual earnings are in your investment.
Yeah, and anything that has a fee, it's eating away at your earnings. So if you're on pace to hit 15% growth, but then you're having to pay, a 2% expense ratio. Now all of a sudden you're down to 13. And then if there's other fees in there, then and then if you're using this mutual fund and a taxable brokerage account, you got to, keep in mind that you will have to be paying taxes on the dividends or on the capital gains. So with mutual funds, they're usually the turnover rate is a lot higher than passive funds. So, the managers are quickly adding and removing, stocks from that fund. So sometimes you get short-term or long-term capital gains, which the investor is in charge of having to pay taxes for. So it's something to keep in mind. If you're using it in a retirement account, then you don't really have to worry about it, especially if it's like a Roth, because, everything in there is growing tax-free. But if you're using it in a taxable account, then it's something you might want to consider as you're looking to invest and grow your money long term.
Right.
So
all right. So let's transition into the index fund and look at what are some of those.
Yeah. So basically, an index fund is an index that tracks a certain market type. So, like for an example, I think the best way to explain this is the S&P 500. So it's the Standard & Poor's 500. So this index measures and tracks the 500 largest companies in the U.S. So it pulls everything together. And what the great thing of some of these index funds is that you're able to buy into these index funds and basically get the exact same performance that the market is going. So the S&P 500 is performing extremely well, like it has been at the time I was recording for the last several months. then you're basically banking on all that. But once it basically mirrors the performance. So if it starts tanking, then the fund's going to start tanking too. But the great thing about index funds is that they're passively managed. So you're not paying high fees to someone to manage the money for you. The turnover rate is a lot smaller. So it's not, stocks aren't being added and subtracted a lot in those. And also it's a great way to, build wealth. You can do one of the set it and forget it, buy into it, have money going there, whatever amount you want, $100, 200, whatever your budget allows, and just have it in there and you don't think about it. And it'll be great to, just keep an eye on it and just see your progress as you move along. But I think index funds are usually the best ways to go about it.
Right. And just as a comparison with the index funds and the mutual funds, Warren Buffett had a bet against a hedge manager, a 10-year long bet, where an index, he said, I bet you the index will outperform your actively managed portfolio. And he ended up winning it. After the 10 years, it was $1 million bet, and he won it because the index fund it performs better on average than most mutual funds.
So the other third investment vehicle is an ETF. What's an ETF and how does it different from the other two?
All right, so an ETF, or an exchange traded fund, is going to be another investment strategy that you could go about, where it's a little different than the index and the mutual funds in the sense that it's traded all throughout the day. Yeah. Just like a stock.
Yeah, well, one thing I think we failed to mention earlier was that mutual funds and index funds are traded at the end of the day. So once the market closes, that's when the buy orders are executed or the sell orders. But yeah, ETFs get traded throughout the day. So if you want to buy and sell ETFs, every couple hours, you have the ability to do so.
Right. So that's one of the biggest differences. There's also a couple of different types of ETFs. There's actively managed ETFs, and there's also the index-based ETFs. So you could have an ETF that, just like those index funds we were talking about, where it's tracking the S&P 500, you could have an ETF that tracks the S&P 500, and you could buy that in the middle of the day versus having the price at the end of the day from the index fund. So if you can, maybe talk a little bit about the actively managed ETF.
Yeah, the actively managed is just, they're exactly like the mutual funds. So they're actively managed by, a hedge fund, these very smart people. I went to Ivy League schools and stuff. The only thing is that the expense ratios, again, tend to be a little bit higher. They're probably not as high as the mutual fund, but they tend to be a little bit higher than an ETF that's tracking an index. So that's something to, keep in mind as you're looking to buy this. Because for me, fees are always a negative thing because they're always eroding your gains. So just keep that in mind when you're selecting and looking at which ones to invest into. But yeah, basically ETFs will, track small cap, mid cap, large cap. There's different types of indexes out there that you can invest into. So once you find the one you like, then all you got to do is just, open up a brokerage account and start buying.
All right. So on a personal note, which ones do you invest in? Do you invest in just one or two?
Yeah,
or all
so
of them?
I prefer the index funds because you're able to set them and forget them. So if you want to do a recurring buy, then, you're buying $50 every week or every month or whatever. Buy it. Expense ratios are really low. And, you don't even have to think about it. I think what a lot of people, and I think it's happened a lot lately, where they get so excited about investing, they buy stocks and they're constantly looking at their app to see how it's performing. And I think with the index funds, it takes that away because even if you look at your app, it's not actively trading. So that price is not going to change. It'll change at the end of the day once it sees with the market performance. But to me, I like index funds. I think they're the best ways to, build wealth and to invest in. But yeah, I mean, I'm sure everyone has their opinion. Not everyone's going to agree with me, but to me, that's the easiest way, and that's what I prefer. But I do invest a little bit in mutual funds and a little bit on ETFs as well, but index funds are definitely my preferred.
All right, so that was an overview of mutual funds, index funds, and ETFs. So hopefully that helps you get a little bit of an understanding of the differences between them so you can make a better decision when going into your own investments. So don't forget, hit that like button, comment down below which one you prefer. Do you prefer mutual funds, index funds, or ETFs? If you're already investing in them, which one are you doing? And don't forget to hit that subscribe button. So thank you guys for watching, and we'll see you on the next one.
Peace.